Good day, fellow investors. I recently made a video on Bill Ackman's Netflix debacle, and the comment section was pretty divergent. Some people said Bill is in IDO, and other people said that Bill did what retail investors need to learn. If you find yourself on the wrong side of the trade, you simply sell and close down. So in this video, I really want to discuss whether Bill made a mistake, or what is Bill Ackman's style of investing, risk and reward that, and I think it will really add a tool to your investment arsenal to understand investing even better. Let's dig in. Because no matter what Bill did this last few months with Netflix, if you look at Bill Ackman's return over the last 17 years, he has destroyed the market. So compound annual return for the S&P 500 since 2004, 9.6%, for Bill, 17%. And if we read his letter where he says that he sold his stake in Netflix, lost 480 million, so it reduced Pershing Square Fund's year-to-date returns by 4 percentage points. Reflecting this loss of today's close, the Pershing Square funds are down approximately 2% year-to-date. If we compare that to the S&P 500 year-to-date, Bill Ackman is still crashing the market. And that's exactly what I want to discuss. Bill Ackman is certainly not an idiot. He knows what he's doing, and that's something we have to apply whenever we are investing. Understanding the business, understanding the risk and the reward of the investment we make, and how the risk, if it materializes, impacts our portfolio, the return, so not a big deal for Bill, but how the risk and reward fits out our portfolio. So Bill Ackman, as he said in the January 26 letter to shareholders, bought 3.1 million shares of Netflix. So he started on Friday 21 January and bought the position here. So for around, let's say, $375. 3.1 million shares times $375, that's 1.16 billion spent on Netflix shares. And when he bought, what was his idea? What was the upside there? He thought, okay, if I invest 1.1 billion into Netflix, and Netflix returns to the previous highs when it was considered an exuberant stock, I double my money. As it is a good business, as he thought it was a good business, he could, by investing in good businesses, double his money easily over the next few years. So for Bill, the upside was a double in a few years. But what was the downside? Well, he bought here, didn't sell anything here, and then after earnings, he sold the whole stake on the first day of the drop here. So he sold everything for 682 million. These are all approximate numbers, but will be a great indication of the thesis here. He lost 480 million, something around that. So compare that to the possible reward. Reward 1.8 billion if Netflix doubles, loss 0.5 billion. So he would make money if half of his plays go bad, he would still make money. Usually Bill Ackman's plays, 4 out of 5 are good, 1 out of 5 is not good. And 1 out of 5, 4 out of 5, with that risk reward, you can understand how Bill Ackman gets to 17% per year. And therefore investing is about the risk and reward, and especially how you manage it. How you manage it, the impact of what you do on your portfolio. And then of course we all love Buffett and his invest for the long term, but don't be confused there. Even Buffett is more like Bill Ackman. If we compare the ownings 2012 with 2021, we can see that American Express is still in, Bank of America, the Coca-Cola, Moody's, US Bancorp, and Wells Fargo, Walmart, Tesco, Sanofi, P&G, POSCO, Philips, Munich Re, IBM, big mistake. Those are all out. So not even Buffett is I buy just once and hold forever. That is the dream for everyone, of course, but you have to learn, you have to take uncertainties, you have to invest, and then from those 20 businesses, a few over the long term will give you this beautiful portfolio that Warren Buffett has and that he holds forever, where the cost for American Express is 1.2 billion, the current market value 25 billion, 1.2 for Coca-Cola, getting 70% dividend on cost, and also made a lot of money. Plus, Ackman is a small player, just 1 billion in Netflix, 1 billion for Warren Buffett doesn't move the needle. And then also something we discussed with this video that is a must video. I really encourage you to watch. We have already 61,000 views. So Seth Klarman says, limit portfolio duration by holding investments with catalysts. So the catalyst Bill Ackman was expecting didn't happen. It's going north, and therefore he closed his position to avoid holding something for the longer term that might just get uglier and uglier. So not that idiotic, because he sure was an idiot in the past, and let's say when he went into a fight with Ackman, he lost 1 billion against Herbalife, but that's not even that much compared to how much he lost with Valiant Pharmaceuticals, where by being stubborn over the years, he lost 4 billion. And despite the losses, Netflix, 500 million, Herbalife, 1 billion, Valiant, 4 billion, he is still the best out there. So investing is yes about losing, taking those risks and calculating the possible risk and rewards and impact on your portfolio. That's Bill Ackman. We have a lot to learn from him. So never forget to ask yourself, when do I get the reward? What is the risk? If the risk materializes, how it impacts my portfolio? The chances of the risk materializing doesn't really matter. If there is a 1% chance and it materializes, it is important that you understand how it impacts your portfolio. That's it. Investing is about risk, reward, and your wealth, your portfolio, your financial goals, your money, and you have to be able to calculate that. I hope I have given you some indications how to do that. If you want more, we'll discuss that. We always discuss that risk and reward on this channel, so please smash that like button, subscribe if you haven't, and check some other videos. Thank you, and I'll see you in the next video.